Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Now, I need you to pay really close attention for a moment because a lot of people have been sending in reviews, which we love. Thank you. But expecting a subscription to Real Investing Journal, the magazine, which we tried many years ago, as a matter of fact, back in 2017, and it didn't work out like we planned, so we don't do it anymore. So we love when you leave the reviews, but we can't send you a magazine because we don't make it. Please remember that all these weekend shows, these archive shows, and they very clearly state their archive shows, are from many years ago. This one from 2017. So ads you hear and mentions made in the show don't necessarily apply anymore. But thanks for listening, and here's the show.
Reality radio for a really great future. We're talking real money.
Hello, and welcome to the show. I'm Don McDonald. That's Tom Cock. There's one little thing you need to enjoy a really great future, particularly a really great retirement, and that is money. And this is one of the few, I'd like to say the only, but then I get called names, but one of the few shows designed specifically to help you actually really invest that money that you earn toward that really great future without getting ripped off. We want to help you out when it comes to dealing with your money. We want to help you manage your money better today and create portfolios, investment portfolios that will make you the wealth you need for tomorrow, but based not on gut feelings, intuition, squiggly lines, or any of that garbage, but based on science.
Well, yeah,
science,
and I
science.
said to somebody recently that there really only is one way to invest.
Yeah.
And they said, that is really arrogant of you to say. And then I had to think about the statement. They were right. There are many ways to invest, all those things you just mentioned, right? But there's only one supportable.
No, that actually, no. Like, you see, that's because investing has been misdefined.
That's true.
Speculating
That's true.
is not investing.
That's true.
Investing is putting your money into something that has the greatest potential to grow more valuable over time with the least amount of volatility in
friction.
In our scenario.
Friction. Expenses, taxes. So,
right.
and what I told them, when I thought about it for a moment, what I said was, you're right, but the way that we talk about investing, the way we try to help you invest is the only one I know that's supportable by real evidence.
There's lots of evidence.
In this case there is.
That's not
bring
arrogant
up these other
because
you
have to define first. It's only arrogant if you don't first define it, I guess. But if you define investing the way it should be defined and it is not in any way, shape, or form related to speculation, then I don't see how it can be arrogant to say there is only one way that has been proven to date by academic research to show real promise for the future.
And another comeback, by the way, is, well, that's what's happened in the past. The future is going to look different.
Right. Future will probably look different.
Yeah, that's true. But
We
what
know
got
that.
Can you base it on? I mean,
Got nothing. You got nothing.
Something
I want to give
else.
out the number again, and I want to remind everyone, I know a lot of you listen to us on the podcast all over the country. Some of you listen to us on Sunday morning. Whenever you listen to us, the time to call us is Saturdays at noon at 877-397-5666, 877-397-5666. And that's noon Pacific time, by the way. If you're on the East Coast, that's 3 p.m. So noon to 2 or 3 to 5. 877-397-5666. And speaking of the past.
Yeah, you already brought up
with
33 years ago, which seems like yesterday to me, but okay, go ahead.
That says a lot about how old you are.
Exactly.
As you told me, I've lived in my house now for 20 years.
Yeah, exactly. Ooh.
Really?
Yeah.
Has it been that long? Wow.
Mine will be 10
Okay.
this summer. It seems like a long
I'm
time,
old.
too. Yeah.
I was doing a little research. I read an article in Kiplinger's a few weeks ago, and I never got around to this, and I wanted to do this. They had the top performing mutual funds over 1, 3, 5, and 10 years. Mm-hmm. They do this all the time.
Yep.
And I was looking at the top, lots of different categories, but I settled on the top 5, the top global stock funds, and I settled on 5 years because the Vanguard Total World Stock Index that we talk about all the time.
VTWSX, a great place to start, by the way.
Right.
I think.
But that fund doesn't have a 10-year track record yet.
Okay.
So I couldn't fairly compare. So I looked at the 5, and I wanted to see, because here's what my point. I was looking at some of these funds, like Morgan Stanley Institutional Global Discovery A, and they show a 5-year return that's almost double Vanguard's.
Wow. Sign me up.
16% per year. Or Guinness Atkinson Global Innovators Fund, or Morgan Stanley's
Guinness?
Institutional...
Drink that one up if you can.
Drink that one up, yeah.
Okay.
Morgan Stanley Institutional Global Opportunity at 14. Polaris Global Value at 12.4.
Rocketing
Or
skyward. Sorry.
Alps Red Rocks Listed Private Equity A at 12.39. I wanted to figure out why they had those big returns. Because Vanguard's Total World Stock Index was 8.71,
Which is,
over that same period.
by the way, here's part of your problem if you're listening now, because you want to go get the 16.
Right.
Most of us, if you're saving and you get the 8, you're going to be fine. You don't need to find the 16, but okay, go ahead.
I wanted to find out what the issue was. Now, this is what people look at the return, only at the return. They do not look any deeper than that.
How much it costs, what the commissions are.
Yeah,
okay.
I mean, the Morgan Stanley stuff,
risk?
5.25 commissions, high expense ratios. But I want you...
Can I stop you there 1 second? Because this is confusing to people. Commission refers to what they're going to charge you to buy that fund. Then there's the cost of the operation of it every day. People don't know that goes in. Yes, that's a part of the
1.69% per year.
And the Vanguard fund is
0.2
something. Yeah, okay.
Yeah.
So, wow.
But now, how many stocks would you guess are in the Vanguard fund?
Oh,
today?
I think it's I want to say 6,000.
No, they're up to 7,500.
Wow, I mean that's good diversification.
How many stocks would you guess are in the Morgan Stanley Institutional Global Discovery?
I'll say 200.
45.
Oh gosh, folks, that's a bet. That's a speculation.
Right.
It has to be.
And what is the common denominator among all of these hot funds?
Oh, they
less
were in
than 100 stocks apiece.
Right. They made big bets. Probably on like financial or whatever, technology, whatever's been hot.
Yep. As a matter of fact, Morgan Stanley's Institutional Global Discovery Fund would not be in the top group if it wasn't for a great 2016 where a couple of stocks they picked did extraordinarily well. Now, here's another thing that you out there can find this number. There is a number that we think is critical because we measure risk based on how volatile securities are, right?
How much things go up and down. Yep.
That's called?
Standard deviation would be one.
Standard deviation is one of the simpler measures to study.
There are others.
Vanguard's standard deviation or volatility rating is just under 11%.
Yeah. You draw a line in the
sense?
middle, it moves around it. By a measure of 11.
The Morgan Stanley funds, both of them, are at 13.5%.
I would have thought it'd be higher, actually, but okay.
Well, that's pretty substantial, though. That's a 20%. That's 20% higher volatility
than the 11. Yeah.
Plus, you have portfolios that are between 30 and 45 stocks, which means if they guess badly and one or two companies fall apart on you, your portfolio is destroyed.
And what's their T-stat?
I didn't pull up all their T-stats.
Yeah, it's getting too far in the weeds. But here's the thing. The problem is it would have been great to buy that 5 years ago and now sell it.
Right.
Because the odds are, and you can look at the track record going back 25, 30 years. You hire these guys, they were red hot, and then they go straight down. It's tough because they're making bets, as you said.
DFA did a study, and they found that the best performing funds over a 5-year period, 70+% of those ended up in the worst performing quarter of funds or out of business for the next 5 years. So
scrap heap.
looking at the hot performers, not going to get you anywhere.
And we'll talk more about that because Jason Zweig wrote a piece today about the hot performers that you need to know about.
Oh, yeah, and that
piece.
fits right into the theme of the show today because Jason was talking about emerging markets.
Bingo.
And we want to talk a little bit about your bias toward buying into the United States.
Well, and just buying what's hot. We just had somebody call us a couple weeks ago and said, you talked about REITs. Should I run out, put my money in that?
Right, and the U.S. stock market has been very hot for the past several years. The
Good
S&P 500 has done extraordinarily well, and nobody wanted to be in some of these other areas we're going to talk about a little later on, and that's the problem. The areas you're not in are the ones that someday will be better.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
For your real life and real future, Tom and Don are talking real money.
I just realized it's really, really sad. It's so sad.
Yes.
That I spend my spare time looking up mutual funds.
It says something.
That is really sad now that I think about it. I'm very depressed.
No, stop it. I'm glad you're doing it. And the lesson learned is don't buy what's hot. We'll talk about that. We'll talk more about that.
I have no life. Angelica. What an angelic name. Angelica, welcome to Talking Real Money.
How can we help you today?
Well, I have no knowledge about investing. I have zero money. How does one get started? What is the minimum amount that I need, and what's the best way to go about this? Because, I cannot afford a broker. So is there a way to do it? Is there a way to get started?
Well, yeah, let me give you a couple of things. One, let me start with, I'm going to come to the easiest one last. Do you have earned income?
Not at this moment. I have been a stay-at-home mom for 37 years, just went through a bad divorce, starting from zero, still have young kids. So I'm in the process of getting myself situated with, a way that I can have income.
But you do, I bet there's one thing you do. You have kids. You have money coming in from other, what?
Yes, I do.
So what do you do on a pretty much daily basis? Do you, like the rest of us, probably spend money on stuff?
Yeah.
Once in a while?
Yeah, you have.
Yeah. This is the coolest thing I ever run into.
I know where you're going now. It took me a minute.
This is the
coolest
I love thing I have ever run into. I have been doing this for a few months now, Angelica, and doing nothing. I do nothing except spend the money I normally spend, and I now have $800 saved in this account.
How come yours is always bigger than mine? That hurts. Okay.
I probably spend more money than you do.
Killing me.
It's called Acorns.
Acorns. Okay.
You type that in on the internet. It shows
Acorns,
up.
and you link it to your bank account. and it rounds up everything you buy, and it puts the money into this really nice portfolio of exchange-traded mutual funds.
You don't have to do a darn thing. Mine's only $620. I've been doing about the same time.
Well, I think I put an extra 20 a month in or something. But
so no, this is great. So you go to acorns.com. We get nothing for this, by the way.
Yeah, this is not a plug we get paid for.
And it just what Don said. It's a rounding service. So when I go look at my bank statement, when I spent, I don't even know what the ratios are, Don, but when I spend a certain amount, it rounds it up to something, and they take that change and they put it into this portfolio that is widely diversified, extremely low cost, and I think they charge us, I think it's $1 a month. Yeah,
they charge $1 a month.
It's a place to start. You're saving something, and you can make it bigger.
I have put $66 away in the last 30 days in my Acorns account.
How do you know
for
that?
Example,
I have to go. I don't know where
I go to the
look.
Acorns account. Like, for example, I paid $227 my utility bill to Duke Energy. I live in Florida. I paid $227.68. They put 32 cents into my Acorns account.
Oh, okay.
And they invested it, and now
I have
growing.
$867.19, and I started less than a year ago.
Oh, wow, that's like magic. I like that.
So you know what it is? Because it's money that just sort of disappears. It's good because it's a disciplined approach to saving. You're investing at a very low cost, and you don't have to do a darn thing about it.
And what you can do, if you think, if at the end of the month you're going, I've got an extra $50 or $100 almost every month, so tell it to put in an extra $50 a month into this, and your amount will burgeon. It'll blossom. You'll be going, in a year you look back and you go, oh my gosh, I got almost $1,000. How did I do that?
That's great.
Try it.
There you go.
Cool.
Acorns.com. And we've, as we've said, been doing it for about a year. I love it. I think it's a great service. I think for a person getting started, there's a great way to get going without doing a darn thing. It's perfect.
I wish I owned a piece of it because I'm telling you, I think this thing is going to be wildly, wildly successful.
Disciplined savings.
It's disciplined savings. It's really, really good. 877-397-5666 is our phone number. Whether you have a little or a lot, we want to help you get it right.
Tom and Don are talking real money.
Yes, it's time for another one of those inevitable interruptions that go with this being a podcast from a live radio show on commercial radio. This one is about something you're going to really enjoy, though, and something from which you could derive a lot of benefit, and that is the fact that we are now bringing our live lunch ed classes to the internet so that you, along with the folks at our offices in Seattle and Phoenix and Portland, can actually attend the event. You just won't get lunch. You're going to have to go get your own. But you'll still get the same great education, and you get a free worksheet, and you get some other perks that go along with the class. Tickets are only $5. That's it, just $5, and you can get them right now at TalkingRealMoney.com. TalkingRealMoney.com. I guarantee that you're going to get a great education, and if you don't feel you did, let me know. I'll give you your money back. It's really just that easy. So sign up for one of our upcoming lunch ed classes today. Don't put it off because somebody might take your seat. Go to TalkingRealMoney.com, TalkingRealMoney.com. It's under the events section of the site, and I hope you'll attend one of the upcoming classes. And now, please continue listening to our program.
Reality radio for a really great future. We're talking real money.
Because real money is the fuel for real life. It is what gets you through life today, and you need to save it and invest it to enjoy a really, really great one tomorrow. And the number one thing people save for in this country, the vast majority of invested assets in America are earmarked for retirement. That's why we talk so much about retirement.
That brings me back to where we just were a minute ago, because getting started with Acorns, which I think really is a great service, because number one, the money comes out of your account. You don't spend it, it's gone. And this is the major fork in the road, because people say, I can't start because I don't have the money. This takes care of that in a way, and then it puts it in a portfolio that is pretty good. It's diversified. It's pretty low cost.
Not as good as we'd like, but it's darn close.
But you just said the magic word that at the end of the day, most of the money probably should go towards, and that's retirement. So if you're saving for retirement, this would not be the best absolute way to start. If you're employed, the number one thing thing to do is to get in your employer plan. Generally, that's a 401k. If it's a government agency or not-for-profit, it could be a 403b. If it's a smaller company, it could be other type of plans.
IRA
but you got to start. That's a place to start. If you don't have that as an option, then an IRA or a Roth IRA. An IRA is money that you didn't pay tax on it. A Roth is money you already paid tax on. But you got to do that first, because if you don't save anything, we can't help you. There's no magic pill we can give.
There will not. And here's what your retirement will look like. It will look like right at the edge of the poverty line.
Yeah.
Because Social Security will only provide you with enough money to put a little bit of food on the table.
It's not designed. People believe it's a pension. It's insurance. It never was designed to fulfill all of your income needs in retirement. But many people, sadly, and I forget what the number, it's a big number, that it's a majority of their income in retirement. You don't want to end up in that situation if you could at all avoid it. And the start is saving something. And that was why I wanted to go back to this, Don, because Acorns cannot build an IRA for you or a Roth IRA. That money is post-tax. There's no quality.
Yeah, but
it's a start.
If you
no,
build
I'm not.
it, like, for example, my portfolio is almost all growth.
Yep.
So there isn't a lot of income or realized capital gains. As a matter of fact, I looked, my dividends so far this year have been just enough to pay my fee. I've had $10 in fees and $10 in dividends.
There you go.
So not a lot of taxable dividends.
So
not going to get killed.
International stocks have been a place to invest for a long period of time, and especially this year. Yeah.
We've always had them in our portfolios.
Remember what people said at the end of last year? What was the big message? It's going to be all about America next year because the new president's getting rid of globalization, right? It's all about America, America, America.
America.
And if you invested that way, you didn't make as much, because here are the numbers. Jason Zweig writes about this today because money's pouring now into Brazil, Russia, India, China, emerging markets. And why? Let me guess why. Well, because it's been the best performing asset investment this year. Emerging markets up over 13% year to date. I mean, crazy.
Year, yeah.
International small companies, 8.4%. And the lagging Standard & Poor's 500, those 500 great companies you trust, up a mere 6% year to date.
And last year,
which is fine, by the way.
At the end of the year, they had a pretty good run. Yeah. They after 3 straight years of losses, which scared everybody out of emerging markets. This is the way
it's shocking.
The antithesis of investing works. That thing that we don't like to call investing, that getting emotional and doing dumb stuff, because the emerging markets have been so bad over 2013, 14, and 15, people bailed out.
Yep.
Well, I don't want to be in emerging markets.
My money.
They're terrible.
Yep.
Now they're up. Shouldn't you have been in them all along?
Yeah.
And an even bigger issue, Tom, and we'll talk about that after the break. An even bigger issue is not just emerging markets, but owning the rest of the world. As Americans, we are really hung up on this country and this country only, but it hasn't been the best.
Tom and Don are talking real money.
Hi, brief break time. I'm Don, and I really wanted to share this with you because this is something I'm really excited about. I have taken much of the work that we do for our online Real Investing Journal and put it into a quarterly magazine that is, I have to say, pretty good and pretty cheap. And it is the only publication I can find anywhere that is totally devoted to real investing. You will find no business news there. You will find no lifestyle information. You will find no hard news, political news, speculation stuff. It's all about the science and the process and the discipline of real investing, and it's a way to keep you on track toward a better future. It comes out 4 times a year, and it's going to cost most people $25 a year. That's all, just $25 a year. But because it's brand spanking new, a limited number of people can become charter subscribers at the lifetime price of $15 per year. Plus, I'll get you a copy of the very first issue as a bonus while the supplies last, of course. So here's all you need to do. Just go to realinvestingjournal.com/subscribe and subscribe. And you'll start getting it in the mail every quarter. If you're one of the first 200 or so to subscribe, you'll also get the very first issue as a bonus. So be one of the first to get the very first magazine ever about investing and nothing but investing. Real Investing Journal, and you can subscribe right now, really easy, realinvestingjournal.com/subscribe, realinvestingjournal.com/subscribe. Now back to the show.
Your guides to a really great financial future. Tom and Don are talking real money.
Because it's really important, and we really do want you to enjoy a better future. And maybe it's arrogant, but we want to show you how to enjoy a better future by investing based on solid science. We believe there's only one way to do this. You've got to do it smart. You've got to do it with at low cost, with global diversification. Global diversification, that's the key. Now, Tom, you meet with people every day.
Just met with somebody today. Yeah, busy.
And we do these things called My Future Blueprint, where people tell us the investments they have, and we analyze how well balanced they are in various asset classes. But what do you find almost universally when it comes to the country in which the bulk of assets are invested?
Well, and you brought this up earlier. If you grew up in the Bay Area, do you have a bias towards keeping your sports teams in the Bay Area, or do you want them to go somewhere else?
To Las Vegas.
To Vegas. And it turns out that here in the United States, most people have most of their money here. And that home field bias carries off into other countries, too. In England, it's like 85% of the investable assets, they're invested in England. Germany's the same way because you trust those companies. You trust the system. You know it.
But the funny thing is I don't think most people realize how many of the companies that they deal with every day are not American companies. For example, chocolate bar from Nestle.
Yeah.
Where are they based?
Switzerland, right?
Switzerland.
Okay.
Absolutely.
And Budweiser beer.
Belgium, and well, actually,
isn't it like
Brazil and
I think?
Belgium.
Yeah, right. Yeah.
And this is, you really have to put this in perspective. And I think DFA does a great job. Dimensional funds.
Okay. Yeah.
Every year they create this wonderful chart that shows which markets did well.
Chart.
In which
it's
years.
what's illustrative.
Graph. It's a graph.
Yeah, something. It's
illustrative.
Yeah.
Between 2000 and 2002, in those 3 years, 2000, 2001, 2002, the U.S. market was down in every one of those years.
And down rather substantially if you own just large company stocks, which most people do.
Well, the U.S. in 2000 was down 13%, 12.5% in 2001, and 23% in 2002.
Yeah.
That's pretty substantial. And yet, there were markets that had positive return. In 2000, it was Denmark, Canada, and Switzerland.
Yeah.
In 2001, it was Australia and New Zealand.
Of course.
And this, just ironically, in 2002, it was Austria and New Zealand.
Okay.
Not Australia, but Austria.
Put another shrimp on the Barbie, right? Yeah, got it.
Yeah,
that's
Austria.
Oh, I get all confused.
Yeah, Austria.
Salzburg, all that stuff. Yeah,
yes,
got it.
yeah,
Vienna.
Yeah, but the U.S. was down in those years.
Your point is that global diversification. So I think we should expand on this just a little bit.
Yeah.
Because actually, many of you are going to remember this whole thing, the lost decade. No reason to invest in stocks because from 2000 through 2009, you lost money being in stocks. Yeah, if you just own large U.S. companies, you did.
Right. You did not lose money in stocks, though.
No.
The S&P 500.
Just the S&P 500. If you own smaller companies and value companies and international companies, you actually made money. Then, just in time, because I know the way this works, people woke up in like 2008, 2009, said, I got to own some of those international stocks because
they're the only things that work.
And you moved your money over to that. Guess what happened from 2010 through 2016? The best markets in the United States. Yeah. That's how hard this business is. That's why you really need global diversification. Smooth the ride out.
And getting into the weeds, I love getting into the weeds on this because, for example, you were heavily invested in the U.S. in 99. Everybody was. Remember that?
It was all about five tech stocks in the United States.
And
Easy.
you made 22% that year.
Yeah.
What would have happened if you took your 100,000 that you had in the market at the end of 98 and you just said, I think I'm going to put that in Singapore. I'm going to put it all in Singapore. Instead of making a lousy little 22%, your $100,000 became, in 1 year, $200,000.
Why didn't you call me and tell me to do that?
I'm sorry, I neglected also, and here's the other one I messed up. Back in, where did it go? It was right here. Oh, yeah, 2008. 2008 was a terrible year for stocks, right?
Yes.
I should have joined
Globally,
those
by the
people.
way, everywhere that year.
I know, but I should have joined those people who said, I'm done with the U.S., I'm going overseas, and I should have just gone to Norway, because Norway returned 87%.
In 2008?
In 1 year. 2009.
2009, okay. 2009 was a good year for
1
stocks.
year. It was
Wow.
a good year, but the U.S. in that year only did 26%.
I don't think I can even name one company in Norway. Is it Nokia? No, I don't think so.
No, I think
Anyway, I can't even name.
doesn't.
so-
No, Google owns Nokia.
That's right.
Didn't they buy them?
They're like
Let's
Amazon.
see.
They just pretty much buy everything.
Volvo is Sweden.
That's Sweden. Yeah, I don't know. I don't think I can name one.
Norsk Hydro. Norsk Hydro.
Oh, okay. Yeah,
big
sure.
big electric company. Norsk
Yeah.
Hydro. I
Mhm.
thought of one. Uh-huh.
Good work.
I got you.
So you got to own all of them.
Yeah, that's the thing. Over the last 20 years, how many times has the United States been the top performing market in the world?
I'm going to say
20
two.
years.
Two?
Two.
Okay.
Absolutely
Thought it
right.
was. Okay. Thank you.
2013 and 2014.
Yeah.
Other than that, and there has only been 1 year where every market in the world lost money, and that was 2008.
Yeah, which was a bit of an anomaly because in other bear markets in the United States, other countries have bucked up and held things in place. So it
Well,
was
in
a bad
2011
year all the way around.
In 2011, we were only one of 2 countries that had a positive return in 2011.
Yeah.
We were only one of 2. I forgot all about that, too. I was watching a show that was made in 2011, and they were talking about how badly their company was hit by the recession. I forgot there was a recession. This is how we forget.
I know.
I forgot
Move on.
there was a little recession
It was
in
kind
2011.
of a tricky time because people were pretty upset about their, and you remember the phrase, your 401k's gone to a 201k. I can remember a lot of people saying, "Oh, I had a 401k, and now I got a 201k."
And what's funny is that was like our second full year in business.
I know.
And yet people want to invest the right way. Isn't it curious?
And by the way,
Good
more
markets
people
and bad.
more
People
people
want
want
to
to
invest
invest
the right way.
today because it feels more comfortable. Because we've been in a bull market for 9 years now, 8 years, whatever it is, long time.
Well, although it's curious, we grew better in a less bullish market
That's
in
true.
terms of Vestry's
Yeah.
growth, our company's growth. I think because right now people are getting into that hot stock mindset again. I bet you think that investing is really, really complicated and hard and difficult to understand, and therefore you're going, I don't want to listen to a show about investing. It's just going to confuse me. Well, it's a lot easier than you think. There are just a lot of people out there who want to make it seem hard because it makes them money. So we want to cut through the crud and the confusion and the complications that appear to be part of investing and make it easy for you. So call us and we will help. Right, Tom?
Absolutely.
Yes, we will. See. Oh, you got your soup?
I do. Split pea
Split
today.
pea?
Yeah.
Did you split all the peas?
I was
yourself?
not. That was a long night. I tell you what, that's a lot of work.
All night split peeing.
Yep.
Please pea splitting.
Gotta be
Easy
careful the
for
way
me
you
to
say
say.
that. Yeah. Hi, you're
Hello.
calling from Yelm. How are you? Can we help you?
Yeah, thank you for taking my call.
My pleasure.
I just have a question
Yes.
on the Acorn account. Do you have to have a debit card to set that up, or can you do it off a checking account?
Off a checking account, I
Yeah.
believe.
I think you don't have to have a
I
card.
I didn't use a debit card. I just gave them my routing info for my bank account.
Okay, because I didn't see that option, so I'll have to keep
Oh,
looking.
maybe
Oh,
not.
well,
I
we're
don't
going to
know.
go
I
look.
don't
Yeah.
know what I
We don't
did,
want to give you bad
It's-
information.
It's been 10 months ago that I set this up, and so let me just see here. Did I use
So
a
you
debit
tried to
card?
go on and do it, and they told you had to have a card to hook up to the
Well,
account?
no, but that was like the options, a debit card or a credit card, and I don't have any. I've never owned a debit card.
Huh.
I only write checks.
Because well, yeah, but I write checks and it uses my checks. I honestly don't know.
We'll look into it.
I'll look into it and find out, and we'll talk about it a little later. Okay?
Okay, perfect.
Thank you.
So much. All right.
We were talking about Acorns last hour. Acorns
Yeah,
is a
last
great way
hour.
to start getting going, saving something, and having it invested at a very low cost. And I'll say it again because people, well, why are you mentioning them?
I know.
We just think it's a good service. We don't, same as we mentioned Vanguard Total World Stock Index. We just think that's a good place to put your money. You're still looking around. I can see that.
Darned if you don't need a debit or a credit card. You do.
Okay.
You do. I mean, since they invented debit cards, I've always had one on my account. Even I have an account at USAA. It has a debit card. I've never once used the debit card. It just is in a drawer somewhere.
So somehow they're rounding your check expenditures too? Is that what you said?
Yeah, because
Wow.
I guess it links to my account.
I
That
don't
debit
write very
card-
many checks anymore.
Yeah.
Rarely.
Well, I think it counts as writing a check. For example, my bill pay.
Yeah, okay.
to-
I do bill pay.
to the energy
Yeah.
company,
Mhm.
to the power company.
So they don't
That-
round those for me. They only round,
They round
debit
those for
cards
me.
expenses. That's why yours is bigger than mine, I guess.
Well, they round everything. I mean, I make my payments on my card to Bank of America, which is my bank, and they round those up 38 cents every time.
Yeah, there you go.
I don't know.
Okay.
But I just looked, and it does say you do need a debit or a credit card.
Okay, there you go. Sorry.
Get a debit card. Just don't use it.
Yeah, I mean,
Just don't use it.
our friend Herb Weisbaum talks about how he doesn't want you to use a debit card for security reasons.
But you can still get it and not use it.
Yeah.
Get the debit
But if you
card,
don't use it, they won't
lock
round it up
away.
because there's no round
because
up.
they round up from everything in my
I see.
account.
Okay.
I never use a debit card.
Okay.
I do not use my debit card on my account at all. But I have
Is that
one.
for security reasons?
That's because it's easier to tap out. It's easier for someone to drain me dry with a debit card than with a credit card.
That's exactly right.
So I never use a debit card.
Okay.
But I do use credit cards because, like, for example, I've got my Delta card now, which, because with the trips to Seattle and buying stuff, I'm going to be like Delta Gold in a year.
You're going to have a special
that
place
kind
for
of-
you.
I know. I get special treatment. 877-397-5666 is our phone number, 877-397-5666. We want to help you invest better. We want to help you build a better future. So give us a call.
Tom and Don are talking real money.
If you're one of the many podcast listeners who's asked, how do I attend one of your classes? Well, we've decided to take our very popular Lunch Ed classes that we've been doing at our offices and also do them in the form of a webinar online. At the same time, I'm doing the class live elsewhere. You can sign up for these live Lunch Ed classes right now at TalkingRealMoney.com, TalkingRealMoney.com. We have a limited number of seats available because we have to pay for them, so reserve your place right now. We're going to have classes in the future on a variety of topics, so check them out regularly at TalkingRealMoney.com. It's under the event section. And there is a small fee for these classes, just $5, but you're going to get a great education, not a sales pitch, and a free worksheet and some other perks. So sign up for our next Lunch Ed class right now at TalkingRealMoney.com, TalkingRealMoney.com. And now, more Talking Real Money.
Your guides to a really great financial future. Tom and Don are talking real money.
Okay, last segment, inside joke, didn't get it. I did not get it.
And I'm going to apologize to our
didn't
caller
get it.
because I was being cute.
We
was
didn't
from,
have a name.
Yeah, the call was from Yelm.
Thurston County. Yeah,
Yelm. Yeah, okay.
And so I said, what's the name? And Tom goes, Ramtha. Now, I don't know anything about Yelm. I know nothing about Yelm. Apparently,
Proving that you don't, yes.
There's a woman there who goes by the name of Ramtha.
I think she's like 300,000-year-old. She channels a 300,000, a warrior from some long time ago.
Yeah, really?
Okay.
300,000
Maybe
years ago
300,000.
was like Australopithecus.
Okay,
or something.
but a long time ago. Thousands of years.
Cro-Magnon. Long time.
She's been doing this for a long time.
Ramtha.
Yeah,
I
well
just
known.
didn't get that.
Okay, my poor reference. I apologize.
And I don't want to be rude.
And I apologize to the caller because I think she might have been a little put off by that.
I doubt it. And
right.
it was funny.
But she did point out that with Acorns, you have to have a debit or credit card.
And Ramtha, the woman who plays Ramtha on television, apparently, she's very attractive. I saw her on
Jay-Z Knight, been around for a long time.
Yeah. So
she used to have a lot of big stars that would come and visit her.
And I bet
there.
she's worth a lot of dough, Ramtha. Hey, maybe we can get her to invest with us now.
Free mentions.
Maybe she can go back in time and change the way people invest going forward.
No. I'll go back and give her all my money in 1986. She'll put it all in Microsoft stock, and then I'll sell it all in 1999. What a run-up that will be.
Before it went straight.
Yeah, exactly.
Like this. My pen in a horizontal position is what Microsoft did in the intervening years.
Well, no, it made nothing for a long time. It's been decent for about the last two. So, anyway, Ramtha, shout out to Ramtha.
877-397-5666 is our phone number. Wait, I'm going to do my Ramtha thing. Give us a call, 877-397-5666. A couple of weeks ago, there was an article in the New York Times about how teachers just get shafted in 403B plans. And I wrote a scathing response to all of those people out there who take advantage of people with by putting annuities in their 401k plans. When we
403Bs mostly.
403B plans. In a little bit, we want to hear your 403B stories because we've got one to share with you, and you're not going to be happy. Sam, you're up next. Welcome to Talking Real Money.
Hi, and thank you very much for taking my call. Just a few minutes ago, you made a comment that you don't get dividends, or what? Do you not do bond funds anymore?
Sure, you should own bonds.
Oh, no, I was talking about my Acorns.
He was talking about his Acorns portfolio that is mostly stocks.
Mine is almost all stocks because I'm aggressive.
But let's talk about that, Sam. This is a good question because we don't recommend owning bonds to make money for the income, though. I mean, this is a good point because you're saying, well, isn't that why you own bonds? No. In our mind, you're trying to make the money with stocks and you're trying to keep the money with bonds. Bonds are the foundation of the portfolio. There are some portfolios you could create for income, but you have to understand that it has a higher risk attached to it.
Right. Okay.
High dividend. I mean, or high yield bonds, for example. That has those bonds have stock-like characteristics. They're going to. Well, you can go back and look. You can go look at Vanguard's high yield bond fund in 2008. I think it lost like 23% of its value. It got pretty beat up. So
almost what the stock.
Yeah, I mean, because these are companies, that issue bonds that have a hard time paying you back when times get tough, as they did in 2008. Does that make sense?
Yes. Okay.
Yeah.
The next question. Yeah. All right. In where do you recommend the bonds should be? Like right now I have it in my IRA. I don't have any in my Roths. I have a little bit still in my 401. I'm retired and I need to transfer out of my 401. So where should the bonds be and why?
Well, it's a great question. So bonds are, unless they are municipal bonds, are tax inefficient. That is, just as you pointed out, Sam, they're paying out dividends. They're paying out interest. You have to pay tax on that. So you don't want to have those in a taxable account. You could have them in a regular IRA. That makes sense, or a 401k. The Roth IRA, because it grows tax-free, and people always question me on this. When you start taking the money out of a Roth, you don't pay tax on it. That's the tax-free part. So generally, we recommend that be stock-heavy because stocks over time have made more than bonds. You therefore own the bonds in individual retirement accounts or 401ks. Does that make sense?
Yes. Okay.
So,
right.
And then if you're going to own bonds in a taxable account, like a regular brokerage account, you want to generally, again, it depends on your tax situation. Don's kind of going to be squinting. Yeah, because it depends on your tax situation. You're probably going to want to own municipal bonds there because you don't pay tax on the interest from municipalities.
That being said, if, for example, I had, and this is just for example's sake, I had $100,000 and $50,000 of it, I was a 50-50 investor. $50,000 was in bonds and $50,000 was in stocks. And it just so happened that I only had $50,000 in my IRAs, Roth, otherwise, whatever they are. I would have all of the bonds in the Roth and the regular IRA, and I would have all of the stocks in the taxable account because the equity positions don't tend to distribute a lot of capital gains. They tend to grow, and those capital gains they distribute are taxed at a rate closer to 15% than your income bracket, unless you're in a very high bracket, then they're higher. But generally speaking, you're going to get a better tax treatment if you split it that way. So all things being equal, overweight stocks in your taxable accounts, overweight bonds in your tax-advantaged accounts.
Okay, all right. And then one more question related to bonds.
Yeah.
Okay, as the interest rates go up, the bond in a bond fund, now like the Vanguard Total Bond Fund, okay, the price per share goes down, but do the dividends typically go up?
Yes.
The
Because
offset.
here's what you see. Let's use Vanguard's total bond index as an example. Vanguard's total bond index has an average duration, last I looked, is about 5 or 6 years.
I was going to say 5.5 years.
Yeah, 5 to 6 years. So that means on average, every 5 years, they're turning over almost all the portfolio into brand new bonds. Some are turning over tomorrow.
Yep.
Some are turning over 10 years from now. But on average, they're turning that portfolio over on a regular basis. And that money, as it turns over, is going into new bonds, paying a higher interest rate. So while you lose in the short run, in the long run, one of the reasons why bond funds work really well in a rising interest rate environment is that they're buying new bonds all along the way to increase your returns. as
Great
opposed to owning an
question,
individual
Sam.
one.
Yep.
Appreciate them all. If you have some, call us.
Tom and Don are talking real money.
I discovered something really interesting not too long ago. It's the fact that people still like getting printed magazines. I read most stuff online, but the vast majority of subscribers to almost every publication known to mankind subscribe to the print edition. I didn't realize. I'm sorry. So I've decided to correct my mistake, and I have created a brand new magazine, the only one that I know of that is totally devoted to real investing. It's called, aptly enough, Real Investing Journal. Real Investing Journal comes out every single quarter. Real Investing Journal is not about speculating. It is not about business. It is not about lifestyles. It is not about politics or other news. It is strictly about the process of building wealth by becoming a real, disciplined, scientific-based investor. And it comes out every single quarter, and you have an opportunity to get it for a lot less money and to lock that price in as a charter subscriber. Annual subscriptions are going to run $25, but if you subscribe soon, you'll be one of the charter subscribers who not only gets it for $15 a year locked in, but you'll also get the very first issue of Real Investing Journal as a bonus while supplies last. So here's how you subscribe. It's really easy. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. And then what do? You subscribe. Then we'll start mailing it to you. And if you don't enjoy it, I'll give you money back. What do you have to lose? You got nothing to lose. So go to realinvestingjournal.com/subscribe, become a charter subscriber to Real Investing Journal, and I guarantee you've never seen a publication quite like this because nobody else, nobody that I can find, focuses on the truth about investing, except, well, of course, now Real Investing Journal. So go to realinvestingjournal.com/subscribe, realinvestingjournal.com/subscribe, and I know I said that a lot, but I want you to remember it. And now back to the show.
For your real life and real future, Tom and Don are talking real money.
And once again, our telephone number is 877-397-5666.
Yeah.
One of the things that has always gotten my ire up, and my ire is easily raised by, look at my ire. It's sticking straight up.
Woo.
Look at every one of those ires is up. I feel all iry now. One of the things that gets me all ired is the way educational institutions and health institutions allow, and I got to tell you, it's on you, administrators of school districts and hospitals. It's on you. The way you allow your teachers to be ripped off, your nurses to be ripped off by insurance companies selling stuff in 403Bs. Ron Lieber wrote an article about this in the New York Times, a couple of them. They're very good. It makes me furious. There should not be insurance products in these 403B plans.
And
Tom.
Dan Solon wrote another great piece this week about, if you don't subscribe to Dan's newsletter, I think it's free. It's free. It comes out, I don't think it's weekly. Anyway, you can type in Dan Solon. Dan tries to give you simple lessons, and you can read it in about a minute. It's easy to understand. And the lesson this week, he talked about a trauma nurse and how difficult her profession is. Imagine the things she sees every day. I couldn't do it. I don't have the emotions. I don't think I have the wherewithal to buck up to that. I think it would melt me down quickly. And his point was, this is not an easy job. This is a very difficult job. She came to Dan and said, hey, I've got this retirement, this 403B. Can you look at it? Dan looked at it. It was loaded with annuities. It was loaded with crummy, actively managed, high-expense mutual funds. No great options for her. So the message, Dan said, was, look, this is a person who works her tail off to take care of all of us. At the very least, can't we, insurance companies, you want to keep loading up with these annuities and expensive mutual funds? Okay, but at least give us index funds as an option there. At least.
Now, there is a little light at the end of this dark, nasty 403B tunnel that the insurance industry promulgates, particularly companies like AIG through their
because they make
Valak
a ton
arm.
of money on this stuff.
Yeah. But there is light. And I'll give you an example from real life. Many years ago, I did a show that was on all over the country, and I was on a very big station in Albuquerque, New Mexico, and I got a call regularly from a guy there who had a terrible 403B plan with the Albuquerque School District. We talked about some of the options, and I said, petition your school board for Vanguard.
Yeah.
So he went out and got about 50 or 60 fellow teachers.
Half of Albuquerque.
To sign up, like a little bigger than that.
Okay.
But you got
saw
him to
the
sign a
TV show.
petition.
Yeah, it's
he
small place.
presented it to the school board, and they put Vanguard in as an option. They can do that. The trustees of the plan have the total freedom to do this. But the thing is the insurance agents and the high-load mutual fund salespeople are the ones who are taking these administrators, these trustees, and these school board members out golfing and out to nice dinners because they know there is a ton of money destined for their pocket selling you bad investments. There should never, ever be an insurance investment in any kind of qualified plan, period.
No, it really shouldn't. And if you're in one of those programs like that, 403B like that, here's an idea. Go open a Roth, as you said, Don. You could do that at Vanguard, so at least you have something that's much lower cost and probably owns assets you don't have available in the retirement plan at your place of work.
Right, and if
At
your
least.
403B doesn't match your contribution and your choices stink, then just fund a Roth. Forget about it completely.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
Reality radio for a really great future. We're talking real money.
We are indeed at 877-397-5666. I'm Don McDonald. That's Tom Cock. We're here every Saturday taking your calls live at noon to 2 on the West Coast at 877-397-5666. You may hear our show at another time, but that's when you want to call.
If you're listening at another time, please don't call this number.
Not
Isn't that
right
what you're
now.
supposed to say? Oh, okay.
Yeah.
I got a question for you. This is interesting. I got this from my public utility district, people that keep my lights on. Yeah. Let me ask you a couple of questions. I found this fascinating.
I'm sure.
Because one of the things we see regularly when people come in to talk about their retirement that's maybe 10 years down the road.
They talk about their utility bill a lot. Yeah.
They do. No, they say, well, our household income's, $120,000. And if we get that much in 10 years from now in retirement, that'll be fine. That'll cover everything. So let me ask you a couple of questions. So a pound of ground beef that today sells for...
Is this plain old ground beef or is this ground
God,
ground chuck, ground sirloin?
Please. Today is, according to this, $3.56 a pound. Okay. I don't know if that's high or low anyway.
That seems a little cheap right now. now based on what I've been paying.
Do you know what that was in 2006, some 11 years ago?
$1.99.
$2.26.
That's pretty close.
58% increase. How about this one?
That's why I eat more chicken.
I do eat a lot of chicken. How about this one? Peanut butter today, a pound of peanut butter, $2.62. Then $1.72. Or my favorite, a movie ticket, they claim $8.65. I think I pay a lot more than that because now our theater has those fancy seats and they come out and massage your feet.
I pay a lot more than $8.65.
But anyway, today they say $8.65, and they say in 2006, $6.55, an increase of 32 cents. The point is,
I get your point.
Yeah, the point, because everybody thinks there's no inflation anymore. Well, inflation doesn't happen. We haven't had inflation in a long time. Well, yeah, unless you're buying ground beef or you're going to the movies or eating peanut butter. Yeah, of course it exists. And if you don't build a plan that looks at 10 years down the road that things are going to be more expensive, you're making a big mistake. I see that all the time. And remember,
how do you build inflation protection into your portfolio?
Well, that's a great question. Thank you, Don.
Softball.
Well, I mean, the only way I know of long term has been really stocks. Long term, and not every year.
Now
not
they
every few
react
years.
negatively immediately to high inflation, but then they're able to. The reason stocks do well is because they're able to increase their prices.
Yeah, right. They just say, guess what? Red apples are now going to be $1.31 a pound instead of $1.03.
If you own an Apple stock.
Not
Apple. No, not Apple.
You got it all confused there. What has the price of Apple gone up in the last 10 years? A lot.
That's what I do.
But the point is, don't ignore inflation when you're doing your planning. And, I mean, this is another one of the issues people face is many of you already retired have pensions, and pensions today are less likely to include inflation riders in them. Inflation increases over time. If you're getting a $40,000 a year pension today, that's worth a whole lot less in 10 years.
Right.
So that's it. That's all I got. I'm sorry.
Well, you also there are inflation-protected securities.
Oh, thank you.
Like TIPS.
Yeah, that's true.
For your bond portfolio.
Yep.
So those
Treasury inflation-protected securities issued by the U.S. government that readjust for inflation. And the fund family that we like called Dimensional Funds has now incorporated them into their – you've heard of a target date fund, right, that says I'm retiring in 20 years. And so my portfolio is built a certain way and it changes over time because you should be taking less risk when you're retiring. Got it? You know that part. But what you might not think about is, okay, how am I paying myself back when I quit? Dimensional Funds has now built these funds that invest a certain way while you're saving, and then when you're taking the money out, they put most of it into these tips so that your check gets a little bit bigger if inflation goes up, and it sustains you for 25 years. It spends the portfolio down, but it still gives you the check.
And it should have inflation protection in it. That's
Makes sense.
Idea.
So, yes, you're right. Thank you for reminding me of those.
I was reading through Dan, because you mentioned Dan's column. So I was reading through it, and, he's got some interesting stuff in there. I want to talk a little bit about one of his bits of advice for somebody who went to his broker. Looking for short-term safety on his money.
Safety, yeah.
877-397-5666 is our phone number. If you have a question about the safety of your money, give us a call.
Tom and Don are talking real money.
Our lunch ed classes that we've talked about occasionally during the show have been so popular that we're now expanding them to our offices in Portland and Phoenix, and we are going to start doing them online too. Well, you won't get the lunch if you do it online. You will get a great education, and you can go out and grab lunch and join us for Lunch Ed. Just sign up at TalkingRealMoney.com. That's TalkingRealMoney.com. There is a very small fee, just $5, but for that, you get a worksheet, and you get access to some special offers, so it's worth it. Sign up now at TalkingRealMoney.com, TalkingRealMoney.com, and get a real investing education. That's TalkingRealMoney.com. Now back to the show.
Your guides to a really great financial future. Tom and Don are talking real money.
Still have time to help you out if you want to call us at 877-397-5666, 877-397-5666. Remember to call Saturdays, noon to 2 Pacific time, 3 to 5 Eastern. Now, Tom, Dan got a question, and I like this question a lot. A guy had an FDIC-insured CD mature, and he came to Dan. He said, I talked to my broker, told my broker I wanted something safe and liquid. Safe and liquid. Now, bear in mind that a 1-year CD, which is not liquid, but a 1-year CD right now earns about 1.3. So it's not liquid. That's the highest rate I could find for a 1-year CD from Ally Bank.
What is the Schwab money market fund paying?
It's like 0.2.
Okay.
So the broker, because brokers don't make any money on money market funds, and they don't make much on CDs.
No,
he
don't.
Recommended the Lord Abbett Short Duration Income Fund. The Lord
Good
Abbott Short
Lord
Duration,
is what I would say.
The Lord Abbett Short Duration Income Fund has a commission of 2.25% upfront.
That's great.
And annual fees of 0.6%.
Oh, that's good. Yeah.
But its SEC yield is 2.17% compared to Vanguard Short-Term Bond Index, which is 1.73%. So Lord Abbett pays more even after all those fees. How is that possible, you ask?
Let me guess. Riskier fixed income?
Interesting. Tom,
Bonds?
what's the highest grade of bond? The highest quality bond is rated
Triple A?
AAA, triple A. Vanguard's portfolio, their short-term bond portfolio, has 70% of the portfolio
So most of it's
in AAA bonds.
Pretty safe stuff. Should
Triple
get
A.
your money back.
The lowest investment grade ranking is triple B, BBB.
Yeah.
Vanguard does have 12%, almost 13% in triple B. They have nothing below triple B in the junk category.
Yeah.
Lord Abbett, on the other hand, triple A, 31%.
Third of it, yeah.
Triple B, 37%. Junk below triple B, 14%.
So basically half of the portfolio is very poor quality.
The devil is always in those details. Always in those details.
You're getting paid more and you're getting
deeper.
risky. Yep, risky.
The broker makes a commission, you pay a higher expense ratio, and you get a higher return. There's a catch. There's always a catch. Juan, you're up next. Welcome to Talking Real Money.
Hi, Juan. How can we help you?
Hi, gentlemen. I've called you guys before and asked you a few questions about this. I'm currently a veteran, separated from the military, and I'm looking into pulling my TSP out, and, I'm ready to take on those fees or taxes. But I plan on using it, to, pay the bills, stuff like that. My question is, if I were to pull it out and then find employment, and then I still have a chunk of it left, where would be a great spot? Because I know I can't throw it back into TSP.
How much? How much money are we talking about, Juan?
It's roughly around $20,000.
And how much is going to be left after you pay the bills?
Well, it's really to survive until I find an employment. So,
okay.
As soon as I get employment, I want to throw it back in somewhere. I just don't know where to put it since I can't put it back into TSP. The TSP's been working great, but
here's the issue for you, Juan. If you take it out and you know you're going to get not only hit with taxes but a tax penalty, right?
Correct.
Yep.
Okay. If there is money left, you only have 60 days to roll it over.
That's what I was wondering. Yeah, right.
So if you go past that 60 days, really you're just now it's start all over again with what's left and go into a Roth IRA. I mean, if you hit it within that 60-day window, you can do a rollover for what's left into a regular IRA. If you hit that 60-day window, which I hope you do, because if you hit that 60-day window, then you won't get hit with taxes or penalty on anything that's left that you get into an IRA. But you'll need to immediately, the minute you have that job, the minute you have that extra income, and you're able to put this back, put it right back before that window closes on you.
Now you're saying put it back towards a Roth IRA or put it back wherever I'm at in regards to TSP?
No, you're going to put it into a regular IRA if there is money left within 60 days. If you are past 60 days and there's money left, then you're just going to fund a brand new Roth starting from scratch.
All right, awesome.
And either one of those, you could go to Vanguard.com. You could open either an individual retirement account or a Roth. From time to time, we have recommended the VTWSX, which is the Vanguard Total World Stock Index. It owns 7,500 stocks in a lot of countries.
At this juncture, though, the key is just to remember, the minute you take it out, the clock starts. You have 60 days to put it back into a regular IRA. If a regular, you don't do a Roth, you do a regular IRA in that first 60 days. After the 60 days, whatever's left, if you're putting it away for retirement, then you're going to probably be looking at a Roth is probably going to be better for you than a regular IRA because it's not likely you're going to need a big tax deduction. As a matter of fact,
Because I know some of the TSP itself is going to be tax-free due to some deployments. So, all right, I'll look into Vanguard and then start the timers as soon as I pull it out.
And call us anytime, Juan. Good luck to you.
Good luck, Juan. Thank you for the call, sir.
Thanks, gentlemen.
By the way,
877-397-5666 is the number.
Yeah,
we really have time.
You mentioned employment, and we need people.
Oh, wow. We were going to talk about that.
It's a great transition.
We never ever we don't talk a lot about our business, Vestory, which is a fee-only investment advisory
and somebody
firm.
else brought up the fact that they listened to the show and we didn't tell them what our minimum. If you want us to manage your money for you, our minimum is $250,000. That being said, we will. If you call me or write me, I'll help you. I've helped a lot of people that don't have the minimum, never going to be clients here. Go own these funds, get on with your life.
That's why we have the show, too.
Yeah, so we'll help you. But if you want us to manage your money, our minimum is $250,000. But
that said, we are a rapidly growing firm, I believe.
Not
because
talking about
we
my
actually
waistline here.
Well, mine is too. But I think it's because we tell people the truth about investing. We don't sugarcoat it. We don't paint it over. It's very transparent. But we need help. We need employees, and we're finding in the Seattle area that there are a lot of jobs available. And we think what we offer is a terrific place particularly for somebody coming out of college with a finance degree or something who really wants to get their feet wet in the industry and maybe learn to become an advisor down the road. We are hiring. We are absolutely hiring.
We have a great 401k. We pay your health and
insurance.
Here's the third thing. You get to work with Tom and Don. Wow. I mean, talk about your big-time benefit.
Dude. And so just send your resume to tom@vestory.com. Tom@vestory, VESTORY.com. Or if you want the email address, just go to talkingrealmoney.com. It's all there.
Tom and Don are talking real money.
Our lunch ed classes that we've talked about occasionally during the show have been so popular that we're now expanding them to our offices in Portland and Phoenix, and we are going to start doing them online too. Well, you won't get the lunch if you do it online. You will get a great education, and you can go out and grab lunch and join us for Lunch Ed. Just sign up at TalkingRealMoney.com. That's TalkingRealMoney.com. There is a very small fee, just $5, but for that, you get a worksheet, and you get access to some special offers, so it's worth it. Sign up now at TalkingRealMoney.com, TalkingRealMoney.com, and get a real investing education. That's TalkingRealMoney.com. Now back to the show.
For your real life and real future, Tom and Don are talking real money.
Wow. Tickets for our May classes are just selling like hotcakes. Now, we only have 20 of the $5 tickets for each class, the Tukwila, the Bellevue, and the Linwood classes, and they're just moving. This is the most orders we've ever had this quickly. So if you want to come to these brand new classes that Tom and I are doing on investing and creating income in retirement, brand new classes, you can get $5 tickets right now, but you need to get them soon at TalkingRealMoney.com, TalkingRealMoney.com.